So we'll get started on time so that hopefully we can finish on time. I'm not going to come between you and the bar, and neither is Bill or his panel. So we'll make sure that we're all on time. I'm standing here not only because I want to feel powerful and because I'm short, but also because we've got an unruly crowd here that I need to monitor carefully. So what we'll do is I will ask each of you guys to introduce yourself, and as you're introducing yourself, I'll also ask you to give us your view on the biotech macroeconomics. So put it another way, you can tell me what you disagree about my talk, and I'll tell you why you're wrong. So let's go ahead and start with Cameron. Why don't we go this way? Cameron, why don't you go ahead?
Perfect. So I'm Cameron Taylor, Managing Director at BofA. Focusing on a mixture of financing and M&A work for emerging biotech companies. Have actually worked in many therapeutic areas, but have covered ophthalmology for about the last decade. Love the area and field. And then as it relates to the question on the overall macro environment, and just to allow people to kind of introduce themselves and we can make it more conversational, I think we're in a period where I think we're going to be seeing more of the same. It's going to be a challenging environment, but there's still a lot of opportunities. There's going to be a bifurcation of the haves and have-nots. But nonetheless, there's a lot of investor capital and strategic capital that's available, but it's going to have to take the right time and the right opportunity for people to strike.
I'm Annabel Samimy. I am a senior analyst at Stifel, and I've been covering biotech, biopharma, and everything in between for the last 25 years, I dare say. And in that period, I've covered a number of ophthalmology companies, whether they're small development stage companies to larger companies that had ophthalmology as a franchise within their businesses. It's been a tough almost 3 years in biotech, I agree. I'm going to be a little bit more hopeful than you, so we can argue about that later. And I'll give you the reasons why in our conversation, but there are possible signs that we might be exiting that those bad doldrums, let's just say.
Thanks, Annabel. I'm Rael Mazansky. I'm a managing director at Deep Track Capital, based in Greenwich in New York. We are a $3 billion investment fund that invests in both public and private companies. I'm one of a couple of folks at the firm that leads our investing efforts in ophthalmology, and I also spend a fair time in oncology as well, and I've been in therapeutics for about 24 years. I think things feel pretty dire in the biotech capital markets. I think the best thing that can happen to the capital markets for ophthalmology companies is that the Fed lowers interest rates. That's really the best thing that can happen to all of us. And it feels like rate stabilization and maybe even lowering is in the cards for next year. So if that happens, I'm optimistic. And if that doesn't happen, it's going to feel like a slog for the next 12 months.
Anupam, Dalal. I'm the Chief Investment Officer at Acuta in San Francisco and New York, where we focus on clinical stage therapeutics and biotechnology and invest across the board in every therapeutic area, but a lot of history, interest, and excitement about things in ophthalmology, particularly retina. I agree with Rael. I think it's pretty. I think the good times are coming. That's what I'd say.
Really?
We're at the bottom. I'm feeling better.
Okay, so this is the last time we'll go back and forth in an orderly fashion like this. The rest is conversation and hopefully disorderly. So, Annabel, first of all, you. Everybody sees doom and gloom. What signs do you see to show us that we've hit the bottom?
Well, Rael mentioned, and you mentioned it this morning, actually. One thing that we've done as biotech investors is we've always lived in our little microcosm of a world. Healthcare and biotech and pharma has always been seen as a very defensive area, and it's pretty immune to everything that's going on around us. That's not the case here. I mean, we just have been through a period of extreme interest rate increases, which we haven't seen for, in the time that I've been covering biotech. And now I can say I've been doing it for a couple decades. We're at that point where inflation is now tempered. The Fed is starting to signal that maybe they're not necessarily decreasing rates yet, but at least it seems like it's stabilizing. And the XBI granted, it's still down about 70% since 2021, but it sort of started seeing a lift at the end of the year, and it's not necessarily short covering. There's some long buying into that. And there's some basic facts that you had noted before. There's hundreds of billions of patent cliffs coming up. There's $500 billion in firepower coming up. 65% of pharma revenues comes from outside. There's still a lot of medical innovation going on, and I think there's reasons to be optimistic about that. There's, a few other things is that like you said, Anupam, sentiment is really at rock bottom right now, and the best buying is when there's blood in the streets, and the valuations are super low. So at some point, I think pharma is going to have to strike, and maybe it's not a proof of concept. Maybe they define proof of concept differently than you and I do. They see proof of concept not just from a clinical perspective, but from a regulatory perspective, from a commercial perspective. And there are going to be companies out there for them to buy. And if that's the case, if M&A starts to come back, then that's going to lift the market back up, and people will be willing to dip their toes back in.
So you're kind of optimistic. And anybody disagree? All of you guys agree with Annabel?
So the one element is that I think that there will be M&A transactions. There will be things, but that's not an indiscriminate reason to invest in all companies. So that's not necessarily the rising tide kind of lifts all ships. And that's where it's sort of where I was going with, where it's more of the same in that there are great companies, and when they reach that point in time where they're attractive or they're put into play, then people will act. And then there are also very interesting science that investors will come in and say, this is the right time, and I have this horizon that works, and I believe that there's going to be upside, but there's still going to be a slog in terms of getting to that point in time. And that's where it does revolve around something that, frankly, even our Fed doesn't know, right? They've continually said they're going to be responsive to the data, and so that's what we don't necessarily know, but at least for the next, near-term horizon, we're probably still in a little bit of this where haves and have-nots. We raised a huge amount of money for a company in the neurology space earlier this week that had a robust amount of demand, and that was on surprising and good news. So that it's there, but it does require you to reach that event and to get to that point versus sort of more indiscriminate, I would say, rising that we saw throughout all of 2020 and some of 2021.
Rael?
Yeah, look, I think we still have more to go here in the death spiral. We still have 200 companies that have negative enterprise values trading below their cash value. It still feels like we're experiencing the hangover of kind of a 3 or 4 year period of irrational exuberance in funding private and public biotech companies. One of the earlier panelists, Jim Murray from Excite, said in his prior life he was scarred from companies going public too early. In my current life, I'm scarred from companies going public too early, and I think we just need to see more consolidation, more mergers, more companies closing down, distributing cash, just more rationality before we can start to be happy again.
Are you happy, Anupam?
I'm almost happy. I mean, I think that, for me, the a couple of things that have been really interesting to observe, and these are just purely anecdotal, but it's over the last 20 years, it's been interesting how informative it's been, is, oftentimes a sign of the end of a bad period is, first of all, funds closing down. Mm-hmm. But the other is when investors are filled with angst at all times, but the basis for the angst kind of evolves. In my conversations with my peers, the guys that I talk to every day about what are you thinking about, what are you worried about, the worry has all of a sudden become underperformance. Like the markets are going to rip, and I'm not for the long short fund community where we can control our net exposure, that we're not exposed sufficiently to the markets ripping. And that's increasingly what's keeping people up at night, that I'm not positioned well for if this recovery that has nascently emerged in the last couple of weeks, if this keeps going, I'm going to have to pivot. And then there's all this panic about, am I pivoting at the wrong moment? I wish I'd pivoted a week ago, and the angst cycle renews. But when I see funds shutting down, when I see this FOMO spirit emerge. When I see my investors and new investors saying, wow, biotech's really kind of been weirdly underperforming. Maybe we should be investing. It feels like something that's going to happen over the next 12.
You know what I worry about, and feel free to interrupt me anytime and chime in over here, is, and tell me if I'm off base. You're right about the interest rate and inflation and so on and so forth, but really the immediate driver in a lot of these things are M&As, or what big pharma does, right? I mean, that's going to be the immediate driver. And now, if they're falling off a revenue cliff, they're going to be investing in things that are going to help them in the revenue right away, which excludes a lot of small caps, because when will the investments go back into the small caps where somebody will say, you know what, I'm willing to take a risk, I'm willing to wait for 10 years, and by the time that cycle turns around, what's going to happen to most of us? I mean, is that a reasonable worry?
Well, I think it's a logical way of looking at it, but there's one thing that's driving biotech right now is sentiment and fear, right? And I think that part of the doldrums that we're in is going to take some time to temper. People have very short memories for positive, bull markets, and very, very long memories with bear markets and when they've gotten burned. And I think what we need to do is get away from, I guess, very short-term focused, catalyst-driven investing and start thinking about longer-term investing, and that hasn't happened yet. And I think
That's from an investment point of view, right? No,
Yes.
I get that.
right. And from a pharma point of view,
But from my
yeah.
friends over here, and who are mostly small cap, and when you think about all the cash raises they want to do, where do they sit? Because by the time that rolls around back to them, that's going to be a while, and they need cash now. So given that, I mean, tell me if I'm right or wrong, and then tell me what you would advise them in this market as a small cap company. I hear what you're saying, Annabel, and I completely agree with you, but I'm looking from the other point of view. I'm looking at my friends sitting over here saying, look, I've got to raise cash within the next quarter. Otherwise, I don't have much left here. They can't wait for the turnaround to come around. I mean, so what advice would you give them at this point?
I mean, there's been some creative ways of going public. I mean, I think public is not necessarily the right answer for all of them. Like you said before, 2020 and 2021 was a period where too many companies went public, and too many companies that shouldn't have gone public went public. And so I think locking in those series rounds is going to be really important, and getting those crossover investors who are prepared to wait a little while until the public markets open up is going to be important also. Talking to strategics early on, like you've said before, discussing partnership, I think those are the areas, and maybe, there's been some reverse mergers as well for companies that are trading below cash, and for companies who've had failed programs to sort of merge into that and go public that way. There's different creative ways of doing it, but maybe my colleagues here have.
Go ahead.
The banker here has some ideas.
Let's speak of small companies specifically in this market, because that's what most of the audience is. So what advice would you give them, Cameron?
I don't invest capital, but in terms of thinking that...
But you just have a whole bunch.
So a lot of it is really also building up the relationships with investors or with strategics, and making sure that that message is incredibly consistent, crisp, aligned in terms of knowing exactly what indication you're going after and how you're going to win. And I think there is a tendency at times in many therapeutic areas where companies will say, well, this is what I'm doing because I'm getting advice to do this. And it's not necessarily playing to win, it's playing to play. And I do think providing investors with a clear-cut rationale of, here's my need. I'm going to be very capital efficient. I think, Hannah mentioned it the other day in terms of what she was talking about of being able to do a bare bones budget, but to say, I can be efficient in getting to this outcome, and this is meaningful, and this is what somebody can respond to, because we are in a market that is a catalyst-based financing market, or even strategics respond to those catalysts. So it's about, right, how can you batten down the hatches and navigate in that environment? I know that sounds like it's easy, but it also requires, I think, a lot of the dotting every I, crossing every T, because you're going to have to go to a broad group of investors, and you need to make sure that people don't fall off on the margin. So it's making sure that just every little answer is very crisp. And so it does require kind of staying up at night and really focusing on those answers, because you can't afford in this market to have, you know, a few people fall off.
Yep. Anupam?
I mean, I think, you know, we had a company that, you know, I realize many people in the room sit in different settings, private companies, public companies, more advanced public companies, et cetera. So I think I'm not sure there's a generic answer that will fit everybody. But, you know, I was thinking about, you know, earlier this year we had a company called Raise that went public, and it was a pretty good IPO compared to many others that have happened this year. And I think what behind the scenes, though, what was really interesting, and I think is a generalizable idea, is that they, from the very beginning, they were very thoughtful about the composition of their investor base, and they were somewhat ruthless about it, meaning that they realized that investors, there were certain investors that were right for a particular moment, and they were willing to move on from that in subsequent moments. So we were a private investor in the company, and we participated in the IPO also. And one of the most interesting, it was a very, very difficult conversation because you know, the book of demand for the IPO was pretty robust, and you know, oftentimes traditionally the existing investors or crossover investors, I mean, part of the reason we do the crossover is exactly to have a call option effectively in the IPO. That wasn't really how it worked. And they took a very forward-looking view of we're going to need to raise a ton of money going forward after this, and we're not going to play that game necessarily. So there were a lot of unhappy people in that process. But you know, in retrospect, I think people realized they were doing something. They were playing a long game on investor composition, and I thought that was really one of the more interesting lessons for everyone here, which is that you know, we being very thoughtful about composition and realizing that different people are fit for different moments is, I think it's a tough conversation, but it's one that, especially now, we all have to have.
Can you go further into that different people for different moments? What do you mean by that? Be more specific.
Well, I'll talk about myself. Like, I mean, you know, if to the extent that Ken Song is a CEO of that company, you know, anticipates that he may need to raise like $1 billion over the next 10 years if his portfolio of product candidates starts to emerge in the way he thinks it's going to emerge, I can't write a check for that, right? Rael can. No, seriously, he can. So he.
I love Ken's.
I'll give you Rael's phone number.
So you know, so I'm not, you know, even though I was the right guy when it was super early, et cetera, when it came to the IPO, like, you know, Ken has a certain motivation to get Rael in, but it's taking away from my allocation, yeah. Right? But I respect that. I respect what he was trying to do, because it's not like he doesn't like me. Nobody, you know, doesn't like me. But you know, he was doing the right thing for the company.
So you did respect me when we kicked you out too? Rael, why don't you go ahead?
Yeah, a couple of pieces of advice for the companies raising money in the room, which I think is most all of them. Raise when you can, not when you have to. It gets said over and over again. People routinely ignore that advice. They get a term sheet that they think dramatically undervalues their company. They say, no, people get emotional, they get pissed off. They say, no, let's wait 6 months, the capital markets are going to improve. If interest rates are not lower in 6 months, the capital markets will not improve. And so, you know, I think the prudent view says if you have a term sheet and there is money available to finance your drug development, you take it if it's on the table, because things might be a lot worse in 6 months, not better. That's point number one. Point number two is, as facetious as it sounds, make sure your trial hits the primary endpoint. And that may sound stupid, but I cannot tell you how many companies I see that commit all sorts of cardinal sins. They ignore their statisticians on sizing. They underpower their trials. They underspend on clinical sites and go to sites that may cost less because they're trying to save money. These are all the mistakes of drug development that even if you have a phenomenal drug that works, may compromise your trial, and there's not, you know, there's no capital more expensive than money that gets spent on a trial that doesn't work. So make sure the trial hits the primary endpoint. That's point number two. Point number three, which I think we've seen a number of interesting examples of, is the regulatory certainty helps an enormous amount, particularly for an investor like me. That distills to, for example, seeking and obtaining a special protocol assessment from the FDA, if that's something that is on the table from Dr. Chambers. Pravin, you're the shining example of a company that had come off a sort of a devastating trial failure. People really didn't believe that Gather-1 was a regulatory grade or regulatory quality study, and when in June of 2021, Iveric obtained a special protocol assessment, that dramatically changed the perception of what that company could be. And so that was a perfect example of how that kind of regulatory certainty helps investors allocate their capital in an efficient way. And if all else fails, if anyone can get a GLP-1 agonist in their pipeline, that's probably the next best thing you can do. So.
What we've seen in this field is some of expectation and failure, high-profile failures will entirely change this field. At least we've seen that as examples. An example would be Fovista, for instance, or lampalizumab. And one might argue that because of those failures, it colored the entire field. Now, whether we like it or not, we've got two high-profile drugs in the market in GA. And one of our colleagues, who will go unmentioned, was sitting in one of these panels with many of you, and he literally said, very, very well respected, and I want your reaction on this, very well respected, and he said straight out, look, if the Izervay and Syfovre launches aren't successful, this is going to impact negatively on the entire ophthalmology market, and this entire market is going to be depressed for a while. Do you believe that?
I'll chime in. Yeah. I think it is an incredibly relevant field, and that we need to see these drugs be successful to show that companies can continue to execute, continue to build, and justify big M&A, or in the case of Apellis, continue to build back up to a meaningful valuation and make money back from a pretty significant down hit within a very short period of time. And likewise, I think even with the anterior segment, I think we want to see companies like Tarsus, we want to see Mibo be successful, we want to see these other drugs be successful to bring life back into these fields and show that doctors are prescribing, that patients are showing up. And so all of these things are critically important to see new drugs continue to drive. And you go back to the earlier slide that you had, which we had worked on, and that we don't have actually that many $500 million drugs or more that have come across in the last decade outside of the anti-VEGF drugs. We need more of them. And so I think that's also critically important, that if they don't do well, then it goes into, okay, how do I make money in this field? And that does impact patients, that impacts all of the companies and the investment that's built around this field.
Okay. Any other thoughts on that, on those two launches?
Just to add to that, I think one of the critically important parts of being successful in GA is that it potentially opens up one of the last other green spaces in retina, which is diabetic retinopathy. It's a similar type of population where you're not really feeling your vision deterioration. And so the motivation to treat is not necessarily there. In GA, yes, these patients are advanced, but if those patients didn't even come to the market, then how can we be assured that patients for diabetic retinopathy are going to come to the market, or those patients who have early stage DME, are they going to be treated with the innovations that are coming out right now? So I guess there's repercussions on some other markets that are similar in vein to GA.
I want to say, though, that's a great point, Annabel, but the interesting thing is it does bring up the importance of nuance and dissecting out what is an extrapolable lesson versus kind of unrelated. So, Pravin, you'll remember years ago, I used to torture you about, well, why is it that
This hasn't stopped.
the performance of anti-VEGFs in NPDR, why is that not a model for what to expect in GA? For exactly the reason you're saying, Annabel, right? But actually, there's a bunch of important explanations for that. And I think we're seeing that play out today.
Yep.
And conversely, if the Syfovre launch, which I think is, obviously we've had some safety issues, and I think the company's now kind of transcending that. But before that happened, I think the launch was on fire. An important question that we just don't know yet, but we're all hopeful, is that there's always been a concern that will the patient persistence on drug die off over time in the absence of a functional benefit. If that were to happen, it's not necessarily something that's true of every drug in retina. So I agree with everyone on the panel. I think it would be disappointing, and it would be an overhang on the next launch, the next intravitreal launch. But it really does depend on what the failure mode is.
Rael, I'll give you the last word.
Yeah, Pravin, I think that risk that the unnamed colleague said from this stage, I think has largely gone away for two reasons. One is that Iveric proved through the value created in the sale to Astellas that GA is, at least the big pharma believes that GA can be a real market and is likely to be a big market. And with the valuation that's being accorded to Apellis today, which is $7.3 billion, so between the two, $13 billion of value against what the market is pricing at something like $1.5 to $2 billion of ultimate sales. To me, I think Iveric and Apellis have largely de-risked the risk that was said last year. So, and I think it's been wonderful for the sector to see $13 billion of value created in a novel therapeutic area by two drugs with a novel mechanism of action. I think it's the best thing that could have happened. It sort of restores faith and just proves that there's enormous innovation and value to be created in retina.
Great, thank you, and I want to thank the panel. At the end of the day, I started this morning saying, look, we're no longer a little orbit by itself. We're part of this big macro economy, and that's still true. But quite honestly, the large players are still looking at signs and signals, and for all of us, we should be rooting for each other and everybody out there, because the better we all do, the better the entire community is going to do. And I hope everybody does well in these challenging times. And again, this is the last time that I'll be here for you. Some of you are saying, thank God it is. But I want to thank Maureen and Craig for creating this. This is really a community, and I hope we stay a community, especially in times like this. Help each other, talk to each other, advise each other, and have a hand and an ear for each other. Thank you for allowing me here, and thank you to the entire panel. Thank you, guys.